Okay, so we're now in the second week, and my first video was about the accounting equation, and we need to take that on a little bit further today. So here's the expanded accounting equation, which I talked to you about last week. Assets are equal to liabilities plus capital, sometimes called equity, plus revenue minus expenses. And that gives us, revenue minus expenses gives us profit. So all the transactions that a business does are going to affect either assets, liabilities, capital, revenue, or expenses. Now we need to take this on a bit this week, and we need to think a bit more about how we actually record transactions, our system of double entry bookkeeping. Now, the first key idea is the dual aspect. The dual aspect idea says that every transaction that a company enters into has two effects. That's where the idea of double entry bookkeeping comes from. So if a company buys a car and pays for that car with money at the bank, there are two effects. The company has a car, it receives a car, and the company gives the seller of the car some money out of the bank account. And sometimes when we talk about the dual aspect of all transactions, we sometimes call it the giving and receiving effect. That every transaction that a business enters into has both a giving and a receiving effect. Now, we know that all transactions affect these different items, these different parts of the accounting equation. And double entry bookkeeping is a system of recording the dual aspect of all transactions. And when we record the transactions, the accounting equation must always hold good. So, for example, if we have an increase in our assets because we've bought a car, the assets go up. If we've paid with money in the bank, there is another asset called cash at bank, which then goes down. The net effect of that transaction on the accounting equation is an increase in one asset and a decrease in another asset. But the accounting equation still holds good. Now, we need to think about debits and credits, the all-important bits of our accounting system. Now, these words, debits and credits, don't really mean much. We could have called them widgets and whatsits, but they've just been called debits and credits. Now, we record a business transactions by making entries in the accounting system. And the accounting system is a set of accounts. And each individual item, such as sales or purchases or cash at bank, has its own account in the ledgers. So we talk about making entries into our accounts. And remember, when we're making entries, remember the rule that the accounting equation must always hold good. Now, the key things to remember when you're doing double entry bookkeeping is to know whether you need to make an entry as a debit entry or a credit entry. And our T accounts, let's assume we've got a T account for cash at bank. The rule is that all the debits are always listed on the left-hand side, and all the credits are always listed on the right-hand side, and that will always be true. Doesn't matter what the account is. Debits on the left-hand side, credits on the right, and that's because as accountants, we like things to be regular and we like rules. Now, if in terms of how the debits and credits relate to the accounting equation, there are a set of rules that you have to know. So, for example, if you have an asset account, like cash at bank, an increase in the asset is a debit. A decrease in the asset is a credit entry. If what we're dealing with are liabilities, remember, liabilities is money we owe people. It's the opposite way round. An increase in a liability account is a credit, an entry on the right-hand side, whereas a decrease in a liability, because maybe we paid off a bank loan, something like that, paid off some money to suppliers that we owe, a decrease in liabilities is a debit. Capital. Remember that capital is what the business owes to the owners. Now, capital, that works in the same way as liabilities do, because capital represents what the business owes to the owners. Liabilities represent what the business owes to everybody else. So again, if we have an increase in capital, we've got a credit, equals in there. And if we've got a fall in the capital, we've got a debit. Typically, capital increases when a business makes profit, because look, profit, revenue minus expenses, is part of capital, what the business owes to the owners. So we've now just got to deal with our revenue and our expenses. Now, as far as revenue is concerned, sales revenue, income, if we have an increase in revenue because we've sold some goods, an increase is a credit to the revenue, the sales revenue account. And if our revenue went down because maybe we had to give someone a refund, then a fall in revenue would be debit. Forgot the equal sign there, look at that. And finally, we deal with our expenses or costs. And an increase in cost and expenses is a debit on the left-hand side of the account, the T account, and a reduction in costs or expenses is a credit. Now this looks like a whole load of gobbledygook probably at the moment, but these are the rules which we use when we're recording transactions in our accounts. And so, as a student of accounting, you need to learn these rules. Accounting is it's quite logical, and once you get used to it, you'll find that double entry bookkeeping is probably one of the most perfect things ever designed. It was invented in the 15th century by Luca Pacioli, and it has never ever been improved. And there's not very many things you can say that about. So that's it for this week. Thank you for watching, and thank you to my daughter Faye for holding the iPad again. Thank you.